Hi everybody, before we start, if you could please raise your hand on the GoToWebinar panel. So I'll do a sound check if you can hear us. Great, thank you for doing that. Welcome and thank you for joining us today for today's webinar, Limitations on Subcontracting, Key Updates and Tips for Compliance. My name is Edna Sergio and I work at Virginia PTAC. We're a sponsored program at George Mason University and funded in part to cooperative agreement with the Defense Logistics Agency. If you're a Virginia-based business, please take advantage of the free one-on-one counseling service that we offer. And we also have the bid match subscription service available to our clients. If you're interested, please take a look at the sample profile on our website. And if you're not based on Virginia business, please take advantage of your local Procurement Technical Assistance Center by finding your local office at the Association of Procurement Technical Assistance Center website. Okay, before we start, I'd like to mention that if you're joining us by phone and do not see the screen, please send us an email so I can document your attendance. But if you can see the slide, you do not need to email us. I'll be taking attendance during the session. To access the handout, please go to our website and log into the eCenter where you signed up for this class. The slides will be available once you are marked as attended. And most of you I have already marked as attended, so you can go ahead and download the presentation slides. This webinar is not being recorded. If you have any questions, please type them on the question window box. If we run out of time and not get to all the questions, we will follow up with you after the webinar. At the end of the webinar, I will be emailing you the evaluation survey for this class. Please fill the survey. It is important for us to know your opinion and what other topics that we could offer. Our presenter today is Megan Lemon. She is an attorney at PilieroMazza in Government Contract Group, where she counsels government contractors and commercial businesses on a broad range of government contracting matters. Her practice focuses on small business procurement, particular issues relating to eligibility and participation in small business federal procurement programs. And with that, I'll let Megan take it from here.
Thank you so much. Good afternoon, everyone. Thank you for joining us today. My name is Megan Lehman. I am an attorney with PilieroMazza. Sorry, hold on one second. I'm trying to get these slides to move. There we go. I work out of our Colorado office, but we are based in DC. We are a full service law firm, but our bread and butter really is government contracting. But we have four main practice groups: government contracting, litigation, labor and employment, and business and transactions. We service clients, all over, particularly those that do business with the federal government. My specialty is on small businesses and more specifically compliance, with the small business programs, inclusive of 8A, SDVOSB, HubZone, women-owned small businesses, and then this general small businesses as well. And a frequent question that we often get is around the limitations on subcontracting. And it is very crucial that if you're a small business prime contractor, that you understand what these rules are, what they mean, how do I comply, so that you're not worried about, any potential liability down the road. And it's best to be mindful of these requirements, as you're preparing your proposal, as you're reaching out to teaming partners and subcontractors to figure out, okay, am I going to be able to comply with the performance of work? Unfortunately, we do often get situations where there's a prime that may not be capable, they don't have the staff or the infrastructure to staff the contract as required. And unfortunately, that's just something that, would prevent you essentially from being able to bid. Or if you've bid and later discovered that you can't comply, you may need to withdraw your bid at that point. So this is a very critical requirement to keep in mind and understand. So today I'm going to talk about, kind of an overview of what are the limitations on subcontracting? What does this really mean? How much work can I subcontract? Okay, how do I calculate it? And then it's part and parcel, but with the uptick of joint venturing and parties coming together to bid on contracts, it's important to understand that the limitations on subcontracting applies also in the joint venture context, and then some other specific performance of work requirements as it relates to joint ventures, because it's kind of a two-step process, but we'll get into that towards the end. Again, feel free to ask any questions in the question box as I go. I will try to answer them as I go. If not, we can get them to them at the end. I do not think I will take up your full hour, but I have the time if you have additional questions. So with that, I'm going to go ahead and dive right on in. Okay, so what are the limitations on subcontracting? In a nutshell, it's a limit on the amount of work that a prime contractor can subcontract to non-similarly situated entities. So I'll first get into what is a similarly situated entity. This concept was added to SBA's regulations back in 2016 and has only recently made it to the FAR. So depending on your contracts, there could be a difference in what's in SBA's regulations versus what's in the FAR clauses that are incorporated into your contract. But we're getting finally to a point where things should more or less line up. So a similarly situated entity is a first-tier subcontractor. So that's someone that subcontracts directly with the prime contractor that has the same small business program status that was required for the prime contractor to have in order to be awarded the contract, and is also a small business. And this is kind of a key point under the NACE code that's assigned to the subcontract. So as an example of this, if a company is an 8A company pursuing an 8A set aside and they get an 8A prime contract and they want to subcontract out to another 8A company, that would qualify as a similarly situated entity. And then as it relates to a NACE code or the small business size status, the determination for whether or not the company qualifies as a similarly situated entity is the NACE code that the prime chooses to apply to the subcontract. So your primes are supposed to apply NACE codes to a subcontract just as the government applies a NACE code to your prime contract. The NACE code that's assigned to a subcontract does not have to be the same as the prime contract. If there is like a niche area of work that's on your prime contract that you're not going to perform and you want to subcontract out, you can do so and you can assign a different NACE code if there's a more appropriate NACE code for that type of work. And maybe that NACE code has a higher size standard than the NACE code that was assigned to the prime contract. So in that situation, the 8A contractor could still be considered a similarly situated entity, even if that 8A company was not eligible to bid on the prime contract because it was too large. But if it's small for the subcontract, that is the key determination for whether or not there is a similarly situated entity. So again, you have to look at the same status that qualified the prime contractor for award. So if there's a company that's 8A and SDVOSB, but the contract was only an 8A set aside, the subcontractor does not also need to be an 8A and an SDVOSB. They just need to be an 8A. So it's important to understand what type of set aside the prime contract is, and then kind of go from there in determining whether or not you have a possible similarly situated entity situation. And if you have a similarly situated entity that is a subcontractor, whatever work that company performs essentially counts as work that the prime contractor performs. So keep that in mind, but it only applies to the first tier subcontractor. It doesn't apply if you keep going essentially down the line. The purpose behind the limitations on subcontracting is to prevent small business contractors from serving as pass-throughs to non-similarly situated entities. So, it could be a large business, but it could just be, a small business that doesn't hold any socioeconomic status or what have you. So it imposes a self-performance requirement only on small business prime contractors. And when I say small business, I don't just mean small business, I mean small business, 8A, SUVSB, HubZone, women-owned. Basically all of these set aside options, if the contract is set aside for any of those socioeconomic designations, the limitations on subcontracting is going to apply. The only instance where it would not apply is if it's a small business set aside and the value is less than the simplified acquisition threshold. This doesn't come up very often, so it's more often than not, you're going to have to comply with the limitations on subcontracting. And one question we get quite a bit is what if I want to hire an independent contractor? I don't have an employee of my company, but I have an independent contractor. Under SBA's regulations, if you have someone as a 1099 independent contractor, they are not considered your employee. They are considered a subcontractor. So in calculating how much work you're going to do as the prime with your personnel, they need to be your people, your W-2s, your employees, in order for them to count against the percentage of work that you perform. So if you say, I'm just gonna go hire a bunch of 1099s, this is all fine, that is not what you're allowed to do. So you need to be very careful in determining if you're able to comply before you're bidding, if you have the staff in order to do it. So getting into, okay, well, how much work can I subcontract? And it does depend on the type of contract that you have and the NACE code that's assigned. So for services, just general services, not construction, the limitations on subcontracting is 50% of the amount paid by the government. So what that means, I'll get to in a minute. So in the case of contracts for supplies or products, if the prime is the manufacturer, then it will not pay more than 50%. Again, it's that 50% requirement, excluding the cost of materials. Again, to non-similar situated entities. I'm not going to get into the non-manufacturer rule, but if the contract is assigned a manufacturing NACE code, and it's a procurement for supplies or products, but you yourself do not manufacture the supply or the product, you have to then comply with what's called the non-manufacturer rule, unless there's a waiver. And that essentially, in a nutshell, requires you to procure the products from a small business manufacturer in the United States that routinely does this type of work. And sometimes about less than 500 employees, but that size standard could change. So for this specifically, this presentation specifically, I'm focusing on the services, the construction, the specialty trade aspect. For general construction, the limitations on subcontracting is 85%, meaning the prime general contractor typically has to perform at least 15% of the amount paid by the government. This does not include the cost of materials. In a specialty trade NACE code, the limitations on subcontracting is 75% of the amount paid by the government, again, excluding the cost of materials. So as it relates to services, it's a 50% self-performance requirement. Companies typically try to go at least 51%, but the regulation does state, you will not pay more than 50%. So you're allowed to go up to 50%, but you can't go over. So the safer, approach is to subcontract a little bit less than that. I mean, maybe 49%, maybe 48, 47, what have you, to give you a little bit of wiggle room if things, kind of change and fluctuate during performance of the contract, particularly if it's not, a fixed price contract. Construction and specialty trade, same thing. Again, it's the amount paid, and it's a much smaller percentage. In construction, you're typically subbing out a lot of the work per se. So it's really, in the construction field, the management aspect of the contract. But so you're more or less permitted to subcontract most of the work. So in determining, okay, what is my limitations on subcontracting? I understand for services, it's 50%. For construction, it's, the limit is 85%. Specialty trade is 75%. What is that? How do I figure that out? So services contracts are typically issued under FAR Part 37. You're performing an unidentifiable task rather than furnishing a supply or a product. So if you're doing maintenance, housekeeping, transportation, research development, IT services, educational services, food services, essentially looking at the particular NACE code and seeing what is the title of the NACE code that's assigned and where does it fall on SBA's chart of NACE codes. Most contracts are the services angle. Then the question becomes, okay, is that construction, which is under FAR Part 36? And those codes fall under, they typically start with that 223 group, 23660, 23260, something like that. So you want to look at, the NACE code will dictate what type of contract you have, whether it's services, supplies, or construction. For services, it can either be, a non-personnel or personnel contract. It can cover services in either professional or non-professional, things along those lines. So again, looking at the PWS, looking at the contract, looking at the NACE code, and that is going to determine which limit applies to you. So going back to similarly situated entities, because it is a very key tool that companies use to determine whether or not they can comply, particularly if they have subcontractors that share their same status and size. So as I said, the prime contractor and a similarly situated subcontractor have to perform the required amount of work themselves. So you have to actually be doing the work yourself. You can't have lower tier subcontractors. The work that has been subcontracted does not count as being subcontracted for purposes of compliance with the limitations on subcontracting. So again, if you're 8A, have an 8A sub, everyone is small under the applicable NACE codes, and you have a sub that wants to perform 20% and you're going to perform 40%, technically you would be performing 60% through that 20% coming from that similarly situated entity. But again, as I noted, if that similarly situated subcontractor that's performing 20% subcontracts farther, any work that they subcontract or further, don't perform with their own employees, like if they have 1099s, that work is considered subcontracted and does not count towards the percentage of subcontracted work. So if you have a situation where you as the prime are performing 40%, your similarly situated subcontractor is performing 20%, but they subcontract out, maybe 15%, then you're left with a situation where you're only quote unquote self-performing 45%. So you're not actually complying, assuming a services NACE code, you're not actually complying with that limitations on subcontracting, because the percentage of work that your similarly situated subcontractor is performing is not that full 20%. So if you need them to get to that 50%, it's important to understand if they have any lower tier subcontractors and how that's going to work. We're not getting into a bunch of the affiliation rules and stuff today, but it is important to understand that if you are bidding with a similarly situated entity, that cannot be used as a basis to find the two companies affiliated under what's called the ostensible subcontractor rule. So this is a rule that essentially could find affiliation for purposes of a bid if a prime contractor is unduly reliant on a subcontractor, either to get the work, to perform the work, who's performing the primary and vital requirements. If you are, a small business prime contractor and have a large business subcontractor, they're clearly not a similarly situated entity, and they're going to be performing all the work. You're going to hire people from them to do your work. Maybe the project manager served with them, and now you're hiring them on. Those are all factors that could lead to a finding of affiliation for that particular contract. But if you're an 8A subcontracting to another 8A, and you're going to give, maybe that 8A company is going to perform more work than you are, as long as they're similarly situated, that cannot be used as a basis to find affiliation under the ostensible subcontractor rule. There could still be other reasons to find affiliation, but that particular rule does not apply if you have a similarly situated entity subcontractor. So in terms of, okay, you've talked a lot about, similarly situated, do they have subs? Like, what do I have to do as the prime contractor to understand, is my subcontractor actually small? Do they have the same status that is important for the prime contract and thus the similarly situated entity rule? So while the FAR is silent on this point, SBA's one of the FAR clauses is silent on this point, but typically prime contractors are allowed to rely on a subcontractor's representations. So, typical reps and certs, all of those boxes you check off when you make a SAM profile. You're allowed to rely on their representations in SAM, or if they don't have a SAM profile, then you should, have them rep and cert to you in writing. That its representations, if they're online, are current, accurate, and complete as of the date of the offer for the subcontracts. So the key to that too is date of offer for the subcontracts. For the prime contractor, the date to determine your size and status is the date that you submit your initial offer, including price. The same date does not necessarily apply if for a subcontractor. Their size status is determined as of the date that they offer, essentially for the subcontract. So those could be very different dates, so keep that in mind as well. But if they tell you, yeah, we're small, generally speaking, you're allowed as the prime contractor to rely on that. In the Hub Zone program, the FAR requires prime contractors to confirm that you're certified by SBA. So essentially you can go to SAM, you can go to DSBS and pull up whether or not, the boxes essentially are checked and whether there is a certification date. For women-owned and economically disadvantaged women-owned, now that SBA is certifying those entities, you can double check for that. However, women-owned is still, as well as economically disadvantaged women-owned, it's still a self-certification for purposes of subcontracts. So as a prime, while you could go check SAM or DSBS to see if the company has been certified by SBA as a women-owned or, economically disadvantaged women-owned, it's not required that they be certified in order for you as the prime to take credit for them as a subcontractor. So obviously it helps if they have been, but there's no FAR requirement to check As somewhat of an aside, for service disabled veteran-owned small businesses, that is no longer going to be self-certification starting in January of 2023. So presumably there will be, a certification date and option in SAM and DSBS for SCBOSBs, just like there is for women-owned and HUBZone and 8A. So eventually, it would be a good idea to check. If you're doing work with the VA, you could always check with CBE for the time being to see if they're certified as such. But generally speaking, you can take, their word at face value. A prime cannot count a similarly situated entity towards compliance if the subcontractor ceases to qualify as small or under the relevant socioeconomic status. So if you should consider, if you're a prime, imposing a contractual requirement to have them, the sub, promptly alert you if their size or status changes. And potentially, you may want to also include an indemnification provision for the subcontractor to indemnify you if they inaccurately represent their size or status or fail to update you. So it's important to kind of stay on top of your subcontractors, especially if you're using them as a similarly situated entity. And even more especially if you have to have them in order to comply with your limitations on subcontracting. So it's important to understand and keep an eye on your sub and see, if they do technically qualify as a similarly situated entity. So in calculating the limitations on subcontracting, we talked about the amount paid by the government. So essentially, how much does the government pay you for the work? Okay, and then do the calculation from there. However, there are some exclusions from the limitations on subcontracting calculation. So obviously it's important to understand what those exclusions are and how to calculate that. So in the services realm, not construction, SBA's regulations provide that other direct costs, ODCs, can be excluded so long as they are not the principal purpose of the acquisition and no small business concern provides the service. So the regulation includes a few examples. This could include airline travel, work performed under environmental remediation, NACE code, cloud computing services, and mass media purchases. So this really needs to be addressed on a case-by-case basis. And again, it goes back to what is the principal purpose of the acquisition? Does a small business concern provide that service? If the answer is no, then it's very possible that costs associated with these, ODCs could be excluded. And oftentimes, if there's like a software that's required, but the principal purpose for the procurement is, servicing that software, providing staffing, providing support, and that's really what it is. But the software obviously costs, a decent chunk. It could potentially even be the majority of the work. It is possible that, if it's like cloud computing, that the software component of that is not included in the calculation. So you might just be left with, the service component. Maybe it's like a help desk or something along those lines. It really needs to be viewed and addressed on a case-by-case, solicitation-by-solicitation basis to see whether or not there's an argument that there are ODCs that may be excluded. Because this could definitely change, your ability to pursue the contract if you have the people, if depending on, what is the cost associated with that and who has to do it. Because again, going back to this a sensible subcontractor rule, you want to make sure as the prime contractor, you're not just complying the limitations on subcontracting, but you're still performing, critical and primary and vital requirements. The FAR does not recognize this ODC exclusion, but certain agencies have class deviations on this and are, have encouraged other agencies to do so as well. And like the VA, GSA, Department of Energy have issued certain class deviations recognizing this ODC exclusion. Where, as somewhat of a side, where your FAR clause may conflict or not be entirely consistent with the SBA regulation, at the end of the day, this is more or less an SBA requirement. The Small Business Administration requires, for set-aside contracts, that under their regulations that you perform a certain percentage. If maybe the contracting officer is really gung-ho about enforcing and checking, but ultimately it may make sense to go with whatever is in SBA's regulations, because if push came to shove, the SBA would probably be involved. And they're going to say, well, our regulations say this. For supplies and construction contracts, the cost of materials, like we discussed, is excluded and is not considered to be subcontracted. So in a construction contract, if you have to, hire all these trucks to perform the construction work, maybe the cost of that truck rental is a materials-based cost. That's not necessarily included in the calculation. But if you then have to pay someone to drive the truck and to work using the truck, that is obviously a service. So it's important when you're understanding, what you're subbing to, who you're subbing to, what type of work you're subbing to, what is their cost breakdown? Because some of their cost could easily be cost of materials that's not included and can impact your calculation. We frequently get asked for services. What does that mean? So SBA has explained that this term cost of materials has never been a term that is meant to apply to service contracts. And it is excluded from the performance of work requirements, although it's not specifically stated in the regulation, because it seems so clear to SBA that if it's a service contract, the key is the services component. So if you have materials or supplies that apply in that service contract, which oftentimes maybe you do not, but to the extent you do, that could be excluded from the calculation. And when I say excluded from the calculation, I mean, so you look at the total amount paid by the government. So if the government pays you $1 million a month for the contract as a whole, but then as the prime, you have to self-perform, 50% or 500,000 of that. But if the government if you subcontract out or have a cost for a material or a supply that eats into that $1 million, you then reduce how you calculate your 50% based on that total amount. So if they're paying you $1 million total, but 100,000 of that a month is for materials or supplies and you're in a services contract, then you only have to perform 50% of that 900,000. So that means you're only doing 450,000 a month as opposed to the 500. So in determining whether or not you've hit that goal or not goal requirement, you need to understand first how to do the calculation and then what's excluded. So again, this really depends on case by case basis, what your contract is for, what's in your contract, and then that's how you can determine whether or not you can comply. Looks like we did get one question before I move on to the next slide. For a service contract, there are cost of materials that can be included in the firm fixed price amount that the government is paying. Could that be excluded? Yes. So you would need to do your own calculation. So if there's maybe there's a supply CLIN, but if there's a total CLIN for the services and materials, you would need to essentially do your own calculation to figure out of this firm fixed price amount, how much of that is for materials, and then you could back that out and go from there. Compliance with limitations on subcontracting is something that you need to self-regulate more or less. It's a little bit more regulated in the joint venture context where you have to actually expressly provide certifications to the government, but technically when you're submitting an invoice to the government on a set aside contract, you're essentially, saying that you're complying with this requirement. So you would want to have that documentation in place saying this is how I arrived at my numbers and here's how I'm in compliance. But yeah, if you have a firm fixed price with cost of materials, that would be excluded in the amount that you need to figure out your percentages from. So if you have a mixed contract where a contract combines services, supplies, and construction, the contracting officer is supposed to select a single NAICS code. Again, there can only be like one NAICS code assigned to procurement. And that needs to describe the principal purpose of the product or service being acquired. Generally, this is based on the part or the component of the procurement, which amounts for the greatest percentage of contract value. It doesn't have to be, but typically is. So whatever the contracting officer selects as the applicable NAICS code, that determines which limitations on subcontracting and performance of work requirement applies. So if it's, a little bit services or a lot of it services, some supplies, they're probably going to pick a services NAICS code. So then you're going to have to comply with that 50%, self-performance for services requirement. Even if there are those supplies, as we just discussed in the prior slide, you can back out those amounts. In no case shall more than one limitations on subcontracting requirement apply. So you're always going to be either at that 50%, the 85%, or the 75%. And again, it only applies, it only applies to the portion of the contract that was actually awarded. And then it says amount paid. So essentially, if there's changes, that come over time to the contract through modifications, that's something you just want to keep an eye on. On this last point, we talked about previously, but if you have contract for services, you exclude any of the supplies or materials. People use those terms kind of synonymously. And then you apply that 50% subcontracting limitation to that services portion of the contract. So, okay, how do I determine whether I'm complying? So in the FAR, the contracting officer has to check a box indicating whether for set-aside contracts, the limitations on subcontracting applies for the base term and each option term, or on an order-by-order basis. So what this is what the FAR says, and then I'll explain what SBA says and kind of go from there. The one caveat to the FAR is that if you're awarded a unrestricted, so full and open MAC, multiple award contract, and obviously there's no particular size or status that you would have had to meet at that unrestricted level, then you would have to comply to the extent there are orders set aside. You would have to comply on an order-by-order basis because there's no, overarching contractual requirement. For SBA, under their regulations state that compliance is measured on essentially a contract period by contract period basis. So base term, and then each subsequent option year. So if you have, common 1-year base, 4-year option, you have to comply at each year. Base year, option year 1, 2, 3, and 4. Reason being is that option years are not guaranteed. So the most common, I think, misconception with the limitations on subcontracting is, we really weren't complying over the first year or two, but it's fine. We have 3 years left. We'll make it up. That's not correct. And what if for some reason the government decides to not exercise that addition, those option years? Then you are left with not complying. So you have to comply on a contract period by contract period basis. If you have a IDIQ contract where orders are going to be issued under that contract, you don't necessarily have to comply at the order level, so like order by order basis, but the contracting officer can specifically require compliance at the order level. I will caveat that if you have an IDIQ contract and you are never guaranteed work, you're not guaranteed to get all these orders under the contract, it would be, dismissive almost to not comply on an order by order basis, because you have to comply on a contract period by contract period basis. So if you don't know you're going to get multiple task orders, there is no way to make up the difference with other task orders if you're not awarded other task orders. So while technically, like let's say you have 2 task orders, they're one at the same time, you could in theory have one subcontractor performing 100% and you 100% of another. It depends on the values and all of that as well. But in theory, you could do that and still comply with the limitations on subcontracting. However, it's very risky if you're not, sure of your orders and the work that you're going to be performing. So best case, easiest case scenario is to comply at the order level, but that's not specifically required unless the contracting officer specifically requires it. I mentioned this before, but again, it's really, really important. Work performed by an independent contractor, 1099s, is considered a subcontract. The only situation where it can count towards the limitations on subcontracting as similarly situated is if that independent contractor were to somehow qualify as a similarly situated entity. So the easiest example is just small business. If you have a small business set aside, you're hiring a small business 1099, that could potentially be a similarly situated entity. But if you're hiring a person is not a small business. A person is not an 8A. So you need to look at who you're hiring as your subcontractor if you're going the 1099 route. Compliance is not necessarily an element of responsibility and not a component of size eligibility, but I will caution that if it's very clear from the face of your proposal that you're not going to comply with the limitations on subcontracting, the contracting officer can essentially reject your proposal on that basis. But you can't necessarily file a protest saying they're not going to comply with the limitations on subcontracting. Rather, you would have to be filing a protest based on the sensible subcontractor rule or some other angle. But again, and this is a very crucial point because we often get a ton of questions or statements, I'll just make it up later, that is not how the regulations are designed. The easiest thing to do is to comply on the contract period by contract period basis. And then if you're on an IDIQ, on an order by order basis. Although technically on the bigger multiple award contracts, IDIQs, it's not necessarily required on an order by order basis, but the surest way to ensure compliance is to comply. So what happens if I don't comply? You could be subject to penalties, including suspension and debarment, and a fine for sure. Contracting officers can require their discretion that the prime contractor demonstrate its compliance at any time during contract performance, as well as upon completion of the contract, if it's not readily available. So you could provide, invoices, copies of subcontracts, listing of the values of the task performed. It's important to really keep track of, how much money is going where, and to do it on a more frequent basis so that you're not scrambling at month 10 or 11 or even 12 to make up for something. It's best to maybe keep a running report on a monthly and no less than quarterly basis to see, okay, this is how much money's come in, this is how much was for services, this is how much I subcontracted out, those types of things. So, I would keep a track of this, every month when you're doing your invoices to make sure. If something goes awry, because maybe there's a bunch of startup costs and things that your subs are going to be helping with. fine. But as the contract goes on, you then, as the prime contractor, need to make up for that going down the road. So it's important to be mindful of this so that you're not scrambling to ensure compliance, at the end of the year, or even as you get into those subsequent option periods. Because again, you want to be complying on a contract period by contract period basis. So the last thing I wanted to talk about was how this applies to joint ventures. Most companies are doing joint ventures, and if you're not, I'm sure your competitors are. So it's something that you may want to consider. And I'm just, for purposes of this discussion today, going to talk about joint venture performance of work requirements, not any of the other, JV requirements. So as a joint venture itself, a whole, the parties that are actual parties to the joint venture, not subcontractors, have to perform, in the aggregate, the percentage of work that is applies to the limitations on subcontracting. So if you have a joint venture performing a services contract, collectively, the JV parties have to perform that 50%. The other 50% can be subcontracted to any firm. So we often get a question, oh, well, I'll take 50%, my partner will take 50%, but then I'm going to subcontract down further. The easiest way in the joint venture context is to treat every subcontractor as a subcontractor to the joint venture, because the qualifying party for the joint venture cannot use a subcontractor to meet its performance of work requirements. So if you have, an SCVOSB prime contract, managing partner to the joint venture that's performing 50%, but they're subbing out maybe, 40% of their work, that's definitely going to impact the calculations, and it's going to impact whether or not they comply, not just with the limitations on subcontracting, but also the additional performance of work requirements. So joint ventures are required to be unpopulated. The JV itself doesn't perform the work. So you have to essentially add the percentage of work that's being performed by the actual parties to the joint venture. And from there, that collective percentage needs to comply with the limitations on subcontracting. Joint ventures also have an internal, kind of like a second level performance of work requirement. So the qualifying party to the joint venture has to perform at least 40% of the total percentage of work that's being performed by the joint venture partners, measured by, again, the dollars received, amount paid by the government. So as an example, if the joint venture collectively performs 50% of the work, the qualifying party to that joint venture only has to perform 40% of that 50%. So it's not 40% of the overall work unless the joint venture is performing 100% of the work. So it's important to understand this distinction, and that there's two performance of work requirements that apply to set aside, small business or socioeconomic joint ventures. Additionally, the qualifying party to the JV has to perform, substantive work. So it's important to understand first the limitations on subcontracting, and then second, this 40% requirement. Again, if you do not comply, this could be a basis for suspension and debarment. And we have seen a significant uptick in Department of Justice investigations, because this is a key requirement. And unfortunately, there are a lot of small businesses that may or may not be taken advantage of, more or less, by larger businesses. Maybe they see this as their work, so they want the bulk of the work share. Well, these rules are in place and designed to protect the small businesses so that they get the work and ensure compliance. So it's really important to keep in mind these performance of work requirements as you go through. And if not, maybe make some adjustments as you can. And that was everything that I had for you today. If you have any questions, we still have some time. I'm happy to answer them. Otherwise, feel free to shoot me an email and I will get back to you.
So while we wait for questions, you can also raise your hand on the GoToWebinar panel if you'd like to ask your question, and I will try to unmute you. So, okay, please make sure to contact us if you have to make an appointment for one-on-one counseling service. If you have any questions, please email at ptac@gmu.gmu or visit us at our Fairfax location. You can also call us at 703-277-7750. And please check our calendar and sign up for any event that might interest you. And I'd like to thank you, Megan, for a great presentation. Thank you, everybody, for joining us. And please make sure to submit the survey that I will be sending to you shortly.
It looks like there were a couple of questions, so I'll go ahead and answer those while we still have a few minutes.
Yep.
One was just on handouts from the webinar. I believe in the chat box there's a link to the slides. There's no, you'll have access to the slides if you attended. One was, are joint ventures required to allow a mentor-protege team to count the past performance of the mentor under a solicitation? So this gets into, obviously just the past performance, not limitations on subcontracting, but I think what the question is asking is, are agencies required to allow a joint venture offeror to use a mentor's past performance? And the answer is yes, kind of. Agencies cannot require the protege or the small business partner to the joint venture individually to meet the same qualifications, but that does not mean that you can rely, or agencies can, not essentially require you to rely exclusively on the mentor. They could impose certain restrictions. So if, let's say, for example, the solicitation requires 3 past performance references, and it says 2 have to be from the mentor and 1 has to be from the protege. More or less, that's permissible. However, the protege should not be required to meet the exact same levels of the requirement. So if, like, let's say for it to be recent and relevant, it has to be, $10 million. The agency should not be requiring the protege to hit that same level. So there's a lot of, deviations and ifs, ands, or buts about it. But more or less, yes, you can use a protege, or sorry, yes, you can use a mentor. How much you can use a mentor is a different question. I don't think we had any other questions, so I think we are probably good to wrap it up.
Yeah, nobody raised their hand on the GoToWebinar panel as well to ask questions. So thank you, everybody. If you don't have any other questions, we'll close out the webinar. Thank you, Megan. Thank you, everybody, and have a nice day.
Thank you.
Bye.